Hello and welcome to CIMA F1 Financial Operations, Chapter 9, IAS 17, Leases. This is a set of notes that you will have to find next to your videos you're listening now, and we try to capture in them in the essence, the spirit of the standard. So if it is to define very simply, a lease is the right to use a certain maybe premises, certain non-current assets over a period of time. And there are some big questions here, but ultimately IAS 17 will require for you to be familiar with the concept of substance over form, and is defining two types of leases just at the bottom of this page: finance lease and operating leases, which you will have to think in terms of what are those transactions telling you in substance, not necessarily in legal form. Because in legal form you may not own the asset, you're just paying certain proportions of money for that space. Let's say the premises you are having your head office is leased, but you have to see if in substance, given the nature of the transaction, and more specifically what standard refers to risk and returns incident to ownership, have or have not been transferred to you. Because in case the risk and rewards of that non-current asset are transferred to you, you may be the owner based on the substance of the transaction rather than its legal form. And the standard defines also the category of operating leases, which in effect, it's the easiest definition in the world, are all the leases that are not finance leases. So the most important part of this standard is to understand the judgment and to exercise some professional judgment in respect of this classification we just mentioned, because the way you will account for a finance lease is completely different than operating lease and has a completely different massive impact in the statement, in the financial statements. So you will have to make sure you are conversant with the two definitions, and just be aware that the future of accounting for leases may be no longer a classification between the two types, but more the case of a finance lease. What's the fundamental difference? Let's look at the finance lease, which is by far more complex than the operating lease. And what we're trying to say is go back to your framework, have a look at the definition of your liability, and let's validate if with a finance lease for your premises, let's say, we meet the criteria for recognition of a liability. So do we have an obligating event? Yes, if we enter such an agreement, we'll have to make periodic payments in respect of the premises under the finance lease. The obligation results in an outflow of resources? Well, yes, the cash flow that we pay periodically. The outflows can be measured accurately? Yes, they would be agreed within the contract. So what you have to think in this context is that even if legally I may not own the premises, if I meet the definition of a liability, shouldn't that be reflected in my statement of financial position? And the answer is yes. That particular non-current asset, even if legally you may not own it, because in substance the risk and rewards have been transferred to you, we meet the definition of a liability, we can reflect it in our financial statements. So how do we present them in the statement of financial position? Well, you will take the net present value of the liability to pay future finance lease rental. So you'll need to be conversant with net present value of the liability, and you're going to calculate the whole value of the liability, present and future, calculate it in present value terms, and then split it in the current proportion, whatever is due within 1 year, and the non-current component, so that stakeholders make some relevant decisions when they look at the proportion of current liabilities, for instance, and they analyze whatever is due, and they do maybe an analysis based on a current ratio for liquidity, but then when they analyze gearing, they know they have to take into account the non-current liability proportion. The gearing is the financial ratio whereby you have debt compared to equity, long-term debt compared to equity, and of course the way you account finance leases, whether they are or not present in the financials, will impact very much this ratio. Now, if you take the asset component, you will have to record it. We mentioned about the liability, but now you'll have to record the carrying value of the asset, which is initially capitalized at the same value as liability. So what happens in the statement of financial position? You are recording the entire value of the lease agreement, both in liability and in the non-current asset. So this way, you're not understating your liabilities. Now, this is your finance lease, and it's just recording that lease agreement in effect in your statement of financial position based on the substance of the transaction. With operating lease, they're fairly straightforward. All you have to remember is that an operating lease is just showing operating rentals as liabilities as they fall due for payment. So are you comfortable with a rent agreement? Well, it would be the same within operational lease in effect. Every year you will have an expense and the liability for the portion due in that year in the financial statements. But as a stakeholder, you do not see the future risk of that particular lease agreement, the operating lease. But arguably it's not important and material because it's a short-term agreement. However, with the finance lease, you are showing the future liabilities and you don't just leave them outside the statement of financial position. So arguably with finance leases, it's a better information you provide to stakeholders about current and future position of the business. Now, one other thing I would like to point you into in terms of direction are certain criterias, and please make sure you are comfortable with those parts. So one issue you could be given in the exam, let's say, is a slight complication, is that you may have uneven pattern of rentals falling due, such as an initial rent-free period, and afterwards, based on the agreement, you would pay the usual equal proportions for the duration of the contract. So what do? The total amounts payable over the life of the operating lease are average. So in effect, you're taking this initial rent-free period and you're trying to create a matching for the remaining amount of the lease value over the life of the contract. Now, there are a few other points which you have to be aware, and that is IAS 16 gives 5 situations that will basically, if you investigate them, will give you some indication if risks and return have been transferred to the lessee by the lessor, and if they were transferred, then you know that the lessee should recognize the non-current asset and related overall liability in their financials. So the first one is the lease transfers ownership of the asset at the end of the lease term. So if you're given that, you would argue that's a finance lease. Then second one, lessee has the option to purchase the asset at a price sufficiently below fair value at exercise date that is reasonably certain the option will be exercised. So let's say they're saying, okay, that's your agreement, and as at the end of the life of the contract, you can buy this machine which was worth 100,000 for 1,000 in effect. So that amount probably is sufficiently below fair value at exercise date. You will have to check that, and then you know that's a finance lease as well. Another point 3, lease term is for a major part of the asset's economic life, even if title is not transferred. Again, look at the machinery, let's say it's 10 years and you've taken a lease of 9 years. Here as a best practice, we are saying as long as it's more than maybe sort of 75% of the useful life that has been under contract under your own use, then you can argue that you're using the asset for a majority of its useful life, therefore it's a finance lease. And if it's 9 out of 10, it's 90% of its useful life with you. Present value of minimum lease payments amounts to substantially all of the asset's fair value at its inception. Again, we gave you some guidance from best practice. So present value of minimum lease payments amounts to substantially equal all of the assets fair value at inception. So what do we mean by that? Well, substantially means minimum 90%, something like this. The leased asset is so specialized that it could only be used if the lessee by the lessee without major modifications being made. So imagine you are in the chemical industry, you have this piece of machinery that cannot arguably be transferred to another buyer easily, and you have to look at that nature as well, because given how specialized it is, most likely the lessee will have to keep it for the majority, ends up keeping it for the majority of its useful life. Okay, so the final tip we gave you in this chapter, and again I'm highlighting you things that we shared with you in these 3 notes, is to presume a lease is a finance lease in your exam unless you have reasonable satisfactory conviction that is an operating lease. So just assume it's finance lease for the exam purposes. Thanks very much for listening, and best of luck with your preparation, and best of luck to your exam.